thanks everyone for joining today. Great to see such a good turnout. I think most of you know me, but I'm Rob Busby. I head the private placement team at NatWest. The purpose of today's webinar is really to provide an overview of the ESG financing market and what the implications could be for the US private placement market. We've had many investor questions over the last few months about really how the green financing trends that we've seen in Europe could develop here in the US and more specifically in the market we all work in. I would say as well on the issuer side, particularly with our UK and European clients, it's very rare now that we have a conversation about a new issue without some kind of discussion around whether to issue in a green format. I'm also joined today by Dr. Arthur Krebbers, who's the head of sustainable finance at NatWest. Arthur is fully embedded across all of our ESG initiatives, which are a big focus of our CEO and NatWest Group as a whole at the moment. I'd also highly recommend Arthur's Issue Your Greens newsletter, which provides a great overview of the market trends in this space. And do just email myself or Jake McCauley if you want to be added to that distribution list. In terms of the format of today's webinar, then Arthur will start with an overview of the ESG financing market. I'll cover the more limited developments that we've seen in the USPP market so far. And then Arthur will wrap up with an overview of the relevant ESG frameworks such as the Loan Markets Association and ICMA. I think you'll see those referenced in more note purchase agreements going forward. Without further ado, I'll hand over to Arthur to kick off.
Thank you very much, Rob. Indeed, to set the scene, if we go to the next slide, really this slide's trying to help illustrate why we think that sustainability and ESG is a fundamental game changer for the capital markets, both private and public. And this really sets out the key drivers of that. I think you'll be very familiar with a lot of the political focus, particularly around climate change, mitigation and adaptation, and discussions around appropriate political responses to that, such as, of course, the Paris Agreement. What may be less well understood, and that's the box just below there in terms of regulatory bodies, is that there's now growing momentum amongst central banks and financial regulators to implement decarbonization friendly policies and tools. If you speak to a central banker, more and more of them see themselves as an important translator, if you like, of climate science and sort of the results of that to the capital markets. You have an important body called the Network for Greening of the Financial System, which is a body of central banks globally, includes about 3/4 of the world's central banks that the Fed joined a few months ago, that are constantly looking at rolling out new macroprudential tools, be that climate change stress testing of banks, be that looking at the concept of fiduciary responsibility for asset owners and whether climate change should be part of that, looking at mandatory disclosure requirements, and indeed looking at whether it makes sense to sort of establish a more formal common language for sustainability. That's starting to be felt in the buy side. What you'll see on the slide here is that there's about 2,300 signatories amongst institutional investors to the UN Principles of Responsible Investment, which require an investor to embed ESG into all stages of the investment process. Parties of growing prominence in this space are the ESG rating agencies. They are starting to be referenced by more investors, by more sustainability indices, and indeed also by more companies as they think about their ESG rating and strategy. There's a couple hundred of them at the moment, but the main parties tend to be your MSCI, Sustainalytics, ISS, and Vigeo Eiris. If we go to the next slide, to give you a sense of the kind of supply that's emerged within the debt market that has an ESG component, we've got some summary stats here. The market has just reached a 1 trillion threshold. We expect it to grow this year by 60% vis-a-vis supply that we saw last year. What you might be interested to see is that the United States has been one of the largest sources of issuance recently. I think that's one of the main trends where we're seeing here, that this market is moving away from just the European agenda and increasingly global, US, Asian prominence as well. When you look at type of supply, it tends to still be about 2/3 of supply, predominantly environmental focus, so like green label, but increasingly we're seeing appetite for also sustainable debt structures with a social or broader sustainability component. Corporates are about 1/4 of the market, but we expect to see significant growth there. And in terms of currency, while close to half of it is still euro, we're expecting to see that become much more representative of the global debt markets, i.e. more dollars, more Asian currencies. And equally, when it comes to other characteristics, in terms of tenor, tends to be the intermediate part of the curve. In terms of rating, it's still skewed towards your pristine credits, AA, AAA, but we're seeing a lot of growth now in sort of the lower credit segment as well. You'll see that the private market is only 5% of supply at the moment. Again, we expect that volume to grow as investors set up more ESG PP portfolios to support distinct projects and assets. If we go to the next slide. An important topic that tends to come up, particularly when speaking more with the American sort of community on this space, is the economic materiality of embracing sustainability initiatives or targets. And there's now a growing body of research that is suggesting that doing so can be quite advantageous. And you'll see on the slide here, it's probably slightly too small font, so I'll share with you some of the key takeaways. I think one body of research looks at what happens to a company after it's issued a green bond or a green private placement, and there's suggestion that there's this halo effect, where there's often an improvement in the company's share price and even in some of their operational metrics, such as profitability, suggesting that when a company musters forces internally to focus on specific environmental initiatives, that is additive to its overall business profile. Secondly, in terms of ESG ratings and focusing on organizations with a stronger environmental, social, or governance rating, there's no research suggesting that is also beneficial. Organizations with better ESG ratings tend to have lower CDS spreads, even if you take into account traditional credit metrics. And also looking at ESG ratings, there's some research suggesting that fund flows in the US can be linked to the Morningstar Globe ranking of that fund, and that Morningstar Globe ranking is effectively derived from ESG ratings from that fund's holdings. So again, some research suggesting that ESG and sustainable debt issuance has positive side effects in terms of performance as well. If we go to the next slide, looking at investment strategies that we're seeing being deployed here within the sustainability space, we've laid out here some of the common strategies. This whole sustainability investing agenda began probably in the 1960s and 70s, when you had oil divestment, anti-apartheid types of strategies. It's very exclusionary focused. The trend we're seeing in recent years is that it's becoming much more sophisticated, the type of ESG integration of strategies that are being deployed. So we're seeing much more advanced risk management, considering ESG as a very appropriate tool to be analyzed alongside traditional credit risk assessments. Particularly because there's a suggestion that ESG can be a very good indicator for future credit events and credit blow-ups. We're seeing momentum strategies where investors are looking to pick future ESG winners and losers and sort of adjust their portfolio accordingly. I mentioned private placements, where we are seeing a rise in ESG liquid and PP funds, with investors trying to buy into a particular asset or particular opportunity, as opposed to a larger company and a bundle of assets. I mentioned on the slide as well, impact funds. These seem to be the more green quantitative funds that try and promise you not just a regular return or index outperformance, but also this idea of a green alpha on the portfolio. And then you've got thematic funds, which try not to have a broad-based sustainability emphasis, but try to really hone in on a specific sustainability theme. So that could be a gender equality fund, a zero poverty fund, for instance. And turning to the next slide, here we set out what are some of the trends we're expecting for this year. I've already mentioned the significant uptick in supply that we're expecting, so that 60% increase from last year. And then so far, that's certainly the case if we look at the momentum we've had in the first 2 months of the year. I think another element that's important at the bottom of the slide, ESG high yield market. As I mentioned, this agenda is moving from your AA, single A companies much more down the credit spectrum as well, getting much more focused not just on multinational firms, but also very much on local and domestic organizations. I highlight sustainability linked bonds, where we'll talk about the exact structural dynamics later. But the idea there is that we're moving from a market where sustainability was defined by how the money was spent to a market where increasingly we're seeing solutions where sustainability is also defined by the margin or the pricing on an instrument. If you don't meet a certain ESG target, that can be a sort of a coupon or a margin consequence. And the final trend I think that's relevant for the corporate domain is what I call shy ESG sectors. A lot of supply emanated from the real estate and the utility space that had very clear and sort of tangible asset bases and environmental agendas. And it's moving now to really all parts of the real economy. So we've seen supply from the luxury goods sector, heavy manufacturing. We've seen announcements even from integrated oil companies and airlines as well. So it's really becoming much more of a sector agnostic theme to that end. With that, I'll hand it back to Rob to dive into the private placement market.
Great, thank you, Arthur. So just moving forward to slide 11. I guess the first thing we acknowledge is clearly the US private placement market is nowhere to this extent developed on this topic. But we do see certain trends which could lead to that changing going forward. Look, I think when you see statistics from financial information providers, often a decent portion of the market of the ESG market is referred to as being privately placed, but from our calculations, the vast majority of that is going to be in MTN format or some kind of public documents or public framework. Certainly the issuance we've seen in our market has been a lot more limited. Looking forward though, it is a huge topic of conversation with issuers. From our conversations with investors, particularly those who manage third-party funds from outside the US, they are getting a lot of questions from those funds about what is the ESG strategy? Is it just a credit issue? Are there specific portfolios that will be set up to invest in green PPs? We know many investors have set up working groups to look at these issues, and we hope we can inform the debate on those topics. Looking forward, I think there's 3 areas where we could see some growth here and that can act as catalysts. The first is the frameworks, which Arthur will talk about later in the presentation. But issuers and corporates of all sizes now can look to external frameworks published by the Loan Markets Association or ICMA, for example, and look at almost a standardized set of criteria that they would need to meet to issue in a green format. Clearly, all of these corporates' businesses are different. Some will be greener than others. Some will find it easier to meet the criteria, where others will find it a little bit more difficult. but there are no frameworks in place where they can assess themselves against that criteria. That reduces the costs of issuing in a green format, both in terms of actual cash expense in advisory and perhaps rating fees where necessary, but also in management time. And we've certainly seen a lot more interest in clients in issuing in a green private placement format as those friction costs have reduced. The second aspect, which I think will help our market in this regard, is really we already have an extensive vetting process in place on the buy side. Unlike a public market deal, which will often hit the screens in the morning and be priced by the afternoon, a typical process takes 2 to 3 weeks. So there's a lot of time built into that for investors who care about this topic to actually dig into the framework that the issuers are using to label their private placements as being green or ESG related. There's plenty of opportunity for Q&A, for specific questions on the frameworks and the portfolios of assets that issuers might be designating. And I think that improves the overall quality of those deals and the green label attached to them. Finally, I think, just by its nature, investors are going to see this in different ways. I think we'll see some investors in our market go the whole hog and set up green portfolios and maybe be willing to price those a little bit differently. I think we'll see some investors who take the view, look, this is another credit risk that we need to manage, and ESG criteria is going to be really important to us, but we see it as something corporates should be doing anyway, and won't necessarily want to create a different product to service that deal flow. And as I said, look, our aim here is just to educate and provide options and to try and help the development of our market over time. Just turning to slide 12, a brief snapshot of green issuance in the US PP market. By our calculations, if we call ourselves around a 95 to 100 billion a year market, then roughly 2% has been issued in some kind of green format or ESG label attached to it. Clearly, there's no really defined standards for what counts as a green label in our market, and that will vary all the way from corporates who've issued under general frameworks which are compliant with LMA principles, to green use of proceeds tranches, to full-blown ECMA compliant frameworks. Perhaps no surprise in terms of the sector and geographic breakdowns, but the vast majority have been from the energy and utility sectors. And our experience has been certainly with European utilities, the vast majority of them already have quite sophisticated green frameworks already set up. So when they do come to our market as a complement to the public bond markets, they already have these frameworks ready to go. They have the reporting in place, and the friction costs for them of issuing in a green format are very low indeed. Interesting that real estate is the third most popular sector there. That is an area where I think we will see more green issuance from, where equity investors are often very focused on this topic. And for a real estate company, generally the listed larger participants in that sector are already really investing in BREEAM compliant buildings and meeting all of the environmental standards that are set for the industry. So again, for that sector, the friction cost of issuing in a green format, again, slightly lower. On the geographic side, no surprise, by our calculations, over half of the green issuance has come from European issuers. I think, as I mentioned earlier in the presentation, there literally isn't a client conversation we have now with the NatWest core corporate client base in the UK and Europe, which doesn't involve the question of should I issue in a green format in the US private placement market. Some issuers conclude that there's no real benefit to doing that yet. Others conclude that they would like to do so anyway, be it because their equity investors are focused on the topic or because they want to help our market develop and help the investor conversations around the topic. Slide 13 just provides a breakdown of the data we've been able to gather from public sources. This is a list of the deals that we understand have been issued in green format in the US PP market. Clearly, we are a private market. I'm sure there's deals that have been done which are not on this table, but maybe just to highlight the NatWest deals here, which are shaded in purple. By our calculations, Kingspan was the largest green corporate PP done. So outside of the utility sector, they printed the equivalent of 750 million euros. And there, that was in an LMA compliant framework, so more akin to what the loan market is using in Europe rather than a full-blown ICMA bond compliant process. And look, I think for many corporates, one of the benefits of our market is going to be it's a good first step to take to issue in a green format. We can be a little bit more flexible than the public market. And in many ways, that's the journey many of our issuers take from the bank market. They start with bank debt, they progress to private placement debt, and then ultimately move on to the public markets. And I think we could see a similar cycle as we go through green issuance as well. Clearly for Kingspan, they're an insulation business. So naturally, a business that lends itself to the green and ESG agenda. The three others, notably utilities, Southeast Water, TenneT from the Netherlands, and Thames from the UK, already had public bond frameworks in place, clear criteria that they already report against on a public basis, and keen to help us develop the green aspect of the PP market. I'll hand back to Arthur to talk about the frameworks that issuers will look to do deals under.
So certainly, if we go to the following slide, we've got a menu here of some of the main options that we tend to discuss with issuers. And then, as I was saying near the start of the presentation, there's really these two technologies that tend to emerge in issuer conversations. It's that use of proceeds component, where for every dollar that you raise, you commit to investing $1 in a project or asset with an environmental or social component. Or it's a KPI-linked approach where the instrument is general corporate purpose. However, the margin or the coupon of the instrument is partly dictated by the company achieving a sustainability performance target. And as you can imagine, for different sectors, for companies of different sizes, there can be sort of pros and cons of those differing routes. From an investor perspective, a number of accounts like the green or sustainable use of proceeds route, because it gives them a lot of clarity around the follow the money principle. It makes it very clear what exact assets the proceeds are supporting, what the impact is of those assets, given particularly the more detailed and sort of micro level reporting that those instruments require, particularly for investors that have some of their own objectives around impact reporting at a portfolio level. Having use of proceeds debt can be quite appealing, and of course there are a lot more precedents. The use of proceeds market has been around for over 10 years now, so there's slightly less concern with greenwashing risks, etc. Equally for investors, they tend to not just look at that use of proceeds commitment, but at the overall sustainability strategy of the issuer to make sure that there's a alignment and congruence between the two. And when it comes to KPI linked, investors that tend to find that appealing are those that want to see organizational change, true transformation of the issuer. Investors that almost want to be equity-like, in terms of using that as a lever to have those broader ESG discussions with the company, and also being able to argue to their own clients that by buying a sustainability linked bond, that there's an economic component as well. Most of the structures are step up. So if the issuer doesn't achieve what you've agreed in the documentation, then there is a economic reward for you. Equally, there's some symmetric structures as well, where there is sort of an element of step down. I'll now dive into some of these structures and the associated market standards. We'll start with use of proceeds on the next slide. So what you see here are the 5 key rules of engagement that a company is expected to adhere to when it labels an instrument as sustainable or green use of proceeds. And these have evolved from the ECMA and the LMA guidelines that Rob was describing earlier. The first component clearly is setting out, when you label something as green, the types of projects that you expect to be supporting. Is that green buildings? Is that renewable energy generation? Is that something around waste management? What are the types of categories? And important to note there that it doesn't just need to be CapEx. In the retail space, we've seen OpEx-driven frameworks. In the tech space, we've seen R&D driven frameworks and projects as well. And then there's a look-back period. So it may well be that a company has already executed some of those projects in sort of 2 to 3 years leading up to issuance, and thereby fulfilled their pledge. The numbers 2 and 3 on the slide here are relatively boilerplate. It requires you're required to have a degree of governance around how you select those projects. That's sort of number 2, and also a degree of governance around how you place or locate the money before you've spent it on those green projects. And again, typically there is a degree of flexibility there in terms of treasurers keeping the funds in the interim period within their general accounts. Critically, when it comes to use of proceeds instruments, you're committing yourself to some form of reporting, typically about 12 months after issuance, and in the case of ICMA standards, verified by your auditor as well. And often that comes down to 2 components. That's reporting on the allocation. So if you did a 100 million green use of proceeds private placement, how much of that went to buildings, how much of it went to renewable energy generation, etc. And then secondly, giving some indicators around the environmental and or social impact of those categories. So again, take the building example. If you've done some renovations or retrofits, what was the associated energy saving that was achieved? Then the final component is the external review, more common in the ICMA form rather than the LMA form. Issuers tend to then obtain a opinion from a environmental consultancy that attests to the credibility of the green structure and indeed its alignment with the company's overall ambitions. When it comes to aligning with the ICMA standards, these 5 components are often enshrined in a framework document, 5 or 6 pages, with quite an extensive introduction on the company and their sustainability strategy as well. And that then leads into more and more these sort of 5 components. It's more of a marketing document. It doesn't have sort of real legal focus. However, it would be referred to in the MPA if that's the route the issuer is going down. When it comes to more and more the LMA aligned structures, we tend to see these 5 components, or at least the first 4, described in the NPA, and then often sort of a separate schedule at the end. That takes me quite nicely to the next slide, where we compare some of the ICMA and LMA standards. But between the 2 market bodies, that there is very active dialogue, but I think there's also a recognition that the nature of the end investor that they're supporting is different. So hence the degree of the standards and sort of how rigid those standards are is a little bit different as well. So if you look at the LMA, the LMA requirements, and as Rob has said, those are a little bit more flexible, right? There's a focus here on supporting an instrument that is sold into a small number of very sophisticated and sort of close-knit investors, again, typically relationship banks. So hence, when it comes to the necessity of an external review, the necessity of an entire framework document, or the needs around post-issuance reporting, that is a lot more loosely defined. The key element there is giving the investor a sense of the types of projects and project categories that will be supported. Conversely, when it comes to the ECMA standards, those requirements are quite clear, quite binary in terms of external review, having a framework document, and giving a sense of the environmental and social impact of the projects. Because again, it's trying to support a publicly sold and syndicated instrument that also goes into less sophisticated and arm's length investors. Turning now to the other type of sustainable finance technology, that's 2 slides down, are sustainability-linked debt issuances, and these emerge from the revolving credit facility market, where clearly a use of proceeds component is less appropriate. But in the last, I'd say 9 months, we've seen growing uptick amongst the non-bank market as well, particularly since June, when we saw the publication of the ICMA sustainability-linked bond principles. And like the use of proceeds principles, that they sort of revolve around five components that you set out in both the prospectus, the NPA, and often also in a separate framework document. The first one is KPIs. So if you're going to link in the coupon of an instrument to meeting a certain target, what then is the metric that you're measuring? And here the idea is, of course, it needs to be measurable, ideally something that you can benchmark to your peers, either sector or geographic peers, and one that's seen to be relevant to the company. Most of the precedents in terms of metrics that tend to revolve around scope 1 and 2 carbon footprint. And the second component is, what do you want to achieve then with that metric? Where do you want to take it from today? That's a sustainability performance target. And here the idea is that you do need to set a target that represents a material improvement in performance, a real transformation of the business model. Something that has real option value from an investor perspective. You need to be clear around the time frame, and also, where possible, you need to align that target to best available scientific models. Again, particularly when it comes to sort of climate-related targets, that doesn't match up with the Paris Agreement, with science-based targets, et cetera, et cetera. And then this is often an area of significant investor focus, because clearly you'd want to avoid greenwashing, where the target is very, very easy to achieve, reflects a business as usual strategy. Number 3, bond characteristics. As I've been saying already, most precedents involve a penalty that's linked to pricing. In the public bond market, that's often been a step up if you don't meet the target, or 2 or 3 targets that you've set. And the private market, we have also seen symmetric structures where there can also be a modest step down if the issuer does meet its predefined sustainability targets. When I say modest, that's typically 5 basis points, not much more. Reporting, important element here is that you're meant to report on at least an annual basis on the KPIs that you've defined, so that the market can have a good sense of the direction of travel. Are you getting close to meeting the targets that you've set out for the company? And then finally, verification, that's mandatory when it comes to sustainability-linked debt for those annual reports. So investors can have a high degree of confidence that the KPI reporting that you're doing is reliable and credible. If we turn to the next slide, we've highlighted here some of the product trends that have emerged in the last 12 months. An important one from the European market is the emergence of the EU green bond standards. This is trying to add further robustness and comparability to instruments that are labeled as green. And I think a critical component of that is the requirement that those project categories that we discussed match up with the European Union taxonomy for sustainable activities, which has a heavy emphasis on trying to be rooted in environmental and climate science. So it's trying to make this idea of a green use of proceeds a little bit more robust to again avoid situations we've seen in the past in the market where projects were badged as green that perhaps they didn't have the desirable long-term, decarbonization consequences. Sustainability debt, I've already touched on that's growing in prominence and appeal in the market. And I guess a final point there on the bottom left is transition finance. This is the idea that the market should be opening up more to sectors with a very carbon intensive profile. So be that construction materials, be that oil and gas companies, aviation, paper and packaging, etc. In order to facilitate that, ICMA came out with a transition finance handbook, which lays out additional disclosure that those companies are meant to provide to investors when coming to market with a green or sustainability-linked instrument. And all that disclosure is not at the instrument level, but very much at the corporate and strategic level. And then finally, the next slide talks to some of the regulatory developments that we're seeing. I think a critical one here as well is the reporting and disclosure requirements, and particularly in Europe, that's encapsulated in the NFRD that sets out the environmental and social metrics that funds are meant to disclose if they intend to label themselves as being sustainable. And we really see this as an important trend in the market. We call it the macroization of ESG. It's moving from what was initially a grassroots theme, bottom-up driven market to one where there's significantly more government and regulatory involvement to both stimulate growth, but also stimulate credibility of sustainability claims. With that, let me hand it back to Rob.
Well, thank you everybody for joining today. Thank you to my colleague Arthur for taking the time to walk us through this interesting topic.